Good afternoon, everyone. I'm Inki Cho, Senior Financial Market Strategist at Exness, and this is your weekly market outlook for January 21st, 2025. The December CPI came in below expectations, effectively easing worries about a potential resurgence in inflation. The headline CPI for December rose 2.9% yearly, aligning perfectly with Wall Street forecasts. Meanwhile, the core CPI increased just 0.2% from the previous month, which was not only lower than last month's figure but also below the anticipated 0.3%. Notably, costs for medical care and housing stabilized, while supercore prices rose only 0.21%, marking a substantial slowdown from the previous month's 0.34%. This decline in CPI sent a wave of relief through both the bond and stock markets, leading to a sharp rise in major tech stock prices and a decrease in long-term yields following the CPI announcements. Following the CPI results that fell short of market expectations, the market is now laser focused on the December PCE price index data set to be released on the 31st of January. With the CPI coming in lower than expected, the outlook for PCE data has been revised downward accordingly as well. Goldman Sachs has recognized a significant drop in car rental and hotel fees, leading them to adjust their December PCE price estimates from 0.22% to 0.15%. Bank of America projects December PCE data at 0.14%, asserting that the CPI results undermine the narrative of inflation reacceleration and substantially reduce the likelihood of any imminent rate hike transition. The recent slowdown in inflation is accompanied by clear indications of a downturn in the U.S job market. Weekly initial jobless claims climbed to 217K, rising by 14,000 from the previous week and surpassing Wall Street expectations of 210K. This increase in claims can be directly attributed to the fires in California, which are expected to impact the data in the forthcoming weeks. FRB Governor Christopher Waller's recent remarks have undeniably shaken market sentiment. His strongly dovish stance indicates that inflation is trending downward, and he makes it clear that continued positive trends could lead to further rate cuts in the first half of the year. Waller is particularly optimistic, suggesting that a Fed rate cut as early as March cannot be dismissed. He also believes that the 2% inflation target may be reached sooner than expected. As a result of his comments, Treasury yields dropped by approximately 3 to 4 basis points. The market's outlook on the trajectory of the 10-year yield is sharply divided. Wells Fargo forecasts that the 10-year yield will decline to 4.25% by the end of this year, citing a slowing labor market as a key factor. Morgan Stanley supports this perspective, urging investors to view the current trend as a strategic entry point for Treasury bonds. In contrast, Bank of America has revised its rate forecast upward, now projecting an end-of-year rate of 4.75%. They believe that the Fed will refrain from lowering rates for the foreseeable future. Nomura's analysis is particularly striking. The firm asserts that a 10-year yield is projected to surge to 6% this year. They warned that the current 10-year yield is unsustainably low given the prevailing inflation levels and physical imbalances. They argue that a yield increase is inevitable in light of the economic cycle's near full employment phase. The Chinese stock market had been doing well recently, hoping that the U.S China relationship would get better after the call between Trump and President Xi Jinping. But things seems to be cooled off a bit after Trump made some comments about the Panama Canal. Speaking about the call, Trump chatted on the phone with Xi just 3 days before his inauguration. There were high hopes that this call might lead to some kind of reconciliation between the two leaders. This was a bit surprising considering Trump had promised to slap tariffs as high as 60% on Chinese goods. Even though things have been looking up lately, the vibe is still pretty tense between the US and China. Carefully review the above data before proceeding with successful trading. This is the end of the market outlook for 21st of January 2025. I'm Inki Cho, the Senior Financial Market Strategist at Exness.